Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph Show. I'm glad you've chosen to join us today. If this is your first time listening to this show, I want to say welcome. I want to invite you to get involved with the Ask Ralph Show. The best way to do that is to send us an email at ralph@askralph.com. If you've got a tax topic or a business topic that you want to talk about, we'd be happy to meet you and talk about those things, or, we can get you some more information, or we may even have you on the show to talk about your particular topic. While we're talking about that, we've got a great podcast library of things we've talked about over the past several months and year. There's all kinds of topics out there that we have illustrated through our podcast. So you can get that on iTunes, you can get that on Android, Google Play, Libsyn, any of those things, or you can go right to our website at askralph.com. But let's jump into a discussion that we started in our last session, and that's the 10 most overlooked tax deductions. And we talked about the first four. That was the state sales tax, reinvested dividends, out-of-pocket charitable contributions, and student loan interest paid by mom and dad. Well, today we're going to talk about one that's disappearing or is gone, except for our friends in the military. And let's talk about that for a second. I would just like to take an opportunity from the Ask Ralph Show to thank all of our people who serve this country or who have served this country. We all owe you a great big debt of gratitude. So while we're talking about the military, let me throw that out there. Now, it used to be if you moved for a job, you could take a deduction so long as that job was more than 50 miles from your previous job. Well, here's the thing that changed. For 2018, moving expenses are no longer deductible unless you're in the military, and the move is due to military orders. So if you thought you would have this deduction for moving expenses, I'm sorry to tell you, it's not going to happen. So if that's something you've been banking on, or you're planning on a big tax deduction for that, I'm sorry, that's not going to fly. But if you are one of our folks serving in the military, make sure you keep track of all of those expenses. So again, not really a deduction for 2018, but it's something a lot of people have taken in the past. I thought we might want to mention it. Our next one, number 6, is child independent care tax credit. So let's talk about the difference between a tax deduction and a tax credit. Which is better? Well, frankly, a tax credit is the best because a tax credit reduces your tax bill dollar for dollar. So let's give you a simple example. Let's say that there's a $1,000 tax credit for child dependent care. Well, that $1,000 credit will directly reduce the amount of federal tax. So let's say that your income, we put it on the tax return, it comes up to, $45,000. So we determine that your tax burden is $4,500. Well, a tax credit would reduce that direct amount of tax, whereas a tax deduction, what we're talking about there, tax deductions, itemized deductions, charitable contribution, sales tax, all those things, those are tax deductions which reduce your taxable income. So they're not dollar for dollar. So let's use our same example. You've got that $45,000 worth of income, but you've got mortgage interest, property taxes. Now let's forget about the $24,000 itemized deduction floor this year. Let's just say you go to itemize. Well, whatever the total itemized deductions, that's going to reduce your taxable income, but it doesn't reduce your taxes dollar for dollar. So that's where this child dependent care tax credit is so important. Now, the law allows you to run up to $5,000 of such expenses through a tax-favored reimbursement account at work. That's the key. I will tell my clients this time and time again. If your employer offers the ability to put aside money pre-tax into this type of tax-favored reimbursement account, you're a fool not to do it because it's the best and the easiest way to get this tax deduction. You go to your HR people and say, look, here's what I want to do. I want to set this up. And what it does is it takes it right out of your earnings. So it's like, that doesn't get taxed at all. Now, one thing people miss, if you run the maximum $5,000 through a plan at work, but still spend more for work-related childcare, you can claim the credit on up to an extra $1,000. Well, that might not seem like much, but listen to me. That would cut your tax bill by at least $200 using the minimum 20% of the expenses. So don't overlook that. Just because you could say, well, I've got this plan at work, I've already maxed it out, and you might even think about the difference. But if your costs are more than that, and trust me, I see the bills for what people are paying for childcare, and sometimes I wonder, does it make sense to work? Some of these bills just floor me. Okay, number 7, Earned Income Tax Credit, or the EITC. Now, this is a sad statistic. One of the things that my secretary Taylor puts together a lot of the things we do on the show, so I want to thank her as well while we're talking about that. But one of the things they talk about here is the Earned Income Tax Credit. 25% of taxpayers who are eligible for the Earned Income Tax Credit fail to claim it, according to the IRS. Now, this was reported by TurboTax. Now, I'm not a big fan of TurboTax, but I like what they say here. Some people miss out on the credit because the rules can be complicated. Others simply aren't aware that they qualify. So what is the Earned Income Tax Credit? Now, here's another cool thing we're going to talk about. Refundable tax credit versus a credit. Now, a refundable tax credit basically means that even if you owe no tax, you can still get this money back. I call it like Robin Hood, because even though you may not have any tax burden, you can get money back from the IRS even if you didn't pay anything in, as compared to a tax credit. So let's use that other example we talked about earlier. You've got $1,000 child tax credit. Well, if you don't have enough income or enough tax to set that off, you're not going to get that money back. So they're not going to let you go into the negative, if you will. But with this Earned Income Tax Credit, you can. The Earned Income Refundable Tax Credit is not a deduction that can range from $519 to $6,431 in 2018. This credit is designed to supplement wages for low to moderate income workers. But the credit doesn't just apply to lower income people. Tens of millions of individuals and families previously classified as middle class, including many white-collar workers, are now considered low income because, why? Because the economy, they lost a job, they took a pay cut, or worked fewer hours during the year. Now, this one gets complicated. So the exact refund you receive depends on your income, marital status, and family size. To get a refund from the Earned Income Tax Credit, you must file a return, even if you don't owe any taxes. Moreover, if you were eligible to claim the credit in the past but didn't, you can file any time during the year after up to 3 years. That's that statute of limitations. So if for some reason, let's say you forgot to do that Earned Income Tax Credit, you go back and look at your returns. And we do this for clients sometimes. They'll come in, a new client to us, and they'll say, I know I've been missing out on something here, but it seems like, I should be getting something else. Absolutely right. So this is something you want to look at. And don't overlook this because, like I said, it can be anywhere from $519 to $6,431 depending upon your circumstances. So like I said at the beginning of this, 2018 taxes are going to be different. It's important that you invest some time in this. We're going to be talking in future shows about, what's the benefit to hire an accountant as compared to use some of this online software. So another thing you need to know about Ask Ralph, and I want to hear from you. If you've got a topic that you want to talk about on the Ask Ralph show, give us a call. My number is 302-659-6560. In fact, if you call right now, I will give you a $50 gift certificate towards the tax preparation that you need to have done for the upcoming tax year. So don't forget to tune in next time as we continue our discussion on the top 10 overlooked tax.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.